Very good afternoon, very good morning. Welcome to FX Week Ahead live market analysis with myself, Giles Coughlin, a chief currency analyst. A very warm welcome to you. Really delighted that you can be here with me to get again today. Very warm welcome, Alejandro, CN, good to have you. Ignatius, Johan, Naha, Setli, Sumen, Warren, Yao. Excellent to have so many good familiar faces here today, and it's a good day to be here. We need to recap some pretty major developments that we've been seeing in the markets, and it's times like this we need to be very much in line and in tune with the key narratives. Don't forget, as we look through different entries, exits, all of this is from an educational perspective, so this is not meant to be a trading signal service. The topic we're looking at today, looking at Japan's inflationary print, very big focus for Japan, particularly their monetary policy at the moment. I will be talking about that. I had a interview with a very large national radio broadcast here last week with Times Radio, and I was talking about inflation. Do have a look on my Twitter feed, and I will send you the link to that. It's my link's up on the Twitter feed. I'll also put it in the chat. I'll just see if I've got that here. If you can just let me know you can see my screen and hear my voice okay. I think that's all coming over loud and clear. Yeah, I think everything's going good. I will share that in the chat option. Okay. Okay, so the topics we'll be looking at is where next after the Fed's latest move. I'm just going to run through what's been happening with the Federal Reserve, how that's impacting stocks and the dollar. We could be about to see a little bit of a turning point in the dollar. We'll be looking at also looking at the dollar Swiss franc. There are potentially some opportunities with dollar Swiss franc after the SMB's surprise 50 basis point rate hike last week. We'll take a look at China's 50, gold, exactly where that's at, key turning point for gold potentially, and the yen. Look at potentially that impacting Japan's Japanese yen. I'll explain to you what the big narrative's going on there and what the things to look for. Also got oil markets. We could be seeing commodities markets just giving a few warning signs. I'll explain what those are. And we'll be just putting into context the surge in global bond yields. So there's absolutely plenty for us to be looking at today. So without further ado, we've got a busy session. I've got a lot to get through, so I want to jump straight into the big picture narrative. Okay, so looking at global indices, what we see is that global indices have been falling since the start of the year. Why? Because investors are starting to worry that growth is slowing as the Federal Reserve is hiking interest rates. And just as in 2018, when the Fed hiked interest rates into slowing growth, and we saw a steep correction in stocks, and you can see in 2018, the end of, we saw sort of a 20+% correction in stocks. Stocks have been selling off on fears that companies' profitability will be hit by the Fed raising interest rates, and the fact that interest rates are rising, it means consumers can have less expendable money. We've seen inflation, which I'll just show you that this is the interview I had here at the Times Radio. I start from about 8 minutes and 4 seconds on the Times Radio, so you can check that out. My link is on my Twitter feed. For some reason, I can't post it on the Q&A control panel for whatever reason today. The big picture here is that equity markets remain a sell on rallies, but we're not interested in selling at these prices because we are at sort of new cyclical lows. Now, if you just take a look at this, you can see that typically when the S&P 500 corrects more than 25%, you can see from this level and below, so when the correction is more than 25%, tends to work out into a US recession. So that means the kind of areas where we might see the Federal Reserve begin to change their outlook on the path of interest rates is around that sort of 25%. And you see we're here, this is the 25% low. Now, last Wednesday, what did Jerome Powell say? He said, we can't guarantee a soft landing, But the biggest mistake the Fed would make is they don't tackle inflation. So what the Federal Reserve has told markets is that inflation is their primary concern, even if it means growth slowing. So you see the problem. So the Fed is going to keep hiking inflation, hike interest rates as long as inflation is high. Now, if you go and look at on Friday week, we go and look on Friday the 10th of June, you'll see what was the last CPI reading for the US. Look, CPI came in 8.6%, above the maximum 8.5% expected. That then led the Federal Reserve to, on the Wednesday, the Federal Reserve then hiked interest rates by an extra 25 basis points. And you remember how they communicated that to the markets? It came through a Wall Street Journal article, and the Fed went from hiking 50 basis points to 75 basis points. Now, that was all priced in slowly over since between the 10th of June and the 15th of June, that got priced in. We're now at the start of a new week, and the short-term interest rate markets, you can see here, are pricing in a 94% chance of a 75 basis point rate hike on the 27th of July. And by the end of the year, short-term interest rate markets are pricing in a 3.59% interest rate level. So interest rate is 1.625. So it's about another 210 basis points roughly are anticipated by the end of the year. So that's like 75 basis points, maybe another 50, and then maybe two other 50 basis points hike before the end of the year. So there's an awful lot of dollar strength getting priced in. You can see dollar smile theory. When the dollar gains, it tends to gain when there's a recession or synchronized global slowdown, right? As well as the monetary policy demands. Now, what have we been seeing? You can see here the economic surprise global outlook. You can see that as this economic surprise has been surprised to the downside in both the US and the world, what's the dollar been doing? The white line, dollar's been rising. So slowing growth, potential for global recession, dollar's been gaining, but a lot of that strength is now in. You can see from previous times that when the maximum kind of pessimism is reached, then you start to see the dollar can sort of recover a little bit. So we're in a scenario where we might see the dollar recover, but a lot of it's going to depend on what happens with inflation. And the next inflation print for the US is the 30th of June. That's when we have the 29th, 30th, 29th of June, when we see the US core PCE data coming in. Now, it's the final data, so it shouldn't necessarily move markets, but that's the next opportunity for the market to see what's happening with inflation. So the bottom line is this: in terms of stocks, if the Fed is seen as more aggressive and has to hike interest rates more quickly, then we're going to see interest rates continuing to rise. Okay, let's see. Oh, I apologize. If you ask a question, for whatever reason, my control panel's not working back my end. So very sorry about that. I can't seem to get. Yeah, that's the problem. I'm so sorry about that. See, and you just asked a question and I can't get to it. There's some software problem on my end. So sincere apologies for that. So if I don't answer questions today, it's because my questions have frozen back at this end. Not to worry, I've got plenty to go through. And you can always contact me directly, either my email or Twitter, if you've got something burning. Now, if you just take a look at this, you can see, we don't want to sell equities at these levels. Even though the outlook is bearish, we've seen quite a lot of selling. What you might see this week is you might see a little uptick, you might see a little correction. But what we really want to see is a fresh catalyst. So we want to see a fresh catalyst for equity markets to maybe move higher. Now, what we're going to be worried about is that commodity markets are flashing some warning signs. You see copper dropping lower? Copper is called Dr. Copper because it tends to be a good indicator about what's happening with global growth. And when global growth is expected to fall, you typically get copper prices falling. Now, WTI and Brent crude prices, they're also very good indicators about global demand. So look, oil markets have been very robust recently because there's been supply issues. Oil markets can't get enough oil to supply, so that's why all these dips have constantly been bought. That's why we've seen all this buying in oil. Now, last week, did we see the first warning signs that commodity markets are starting to look at growth, world growth? Now, let me show you what happened in 2008. If you look in 2008, I was speaking with one of my colleagues at a financial source, and you see how in 2008 that when the S&P 500 officially hit a bear market in July 2008, it broke through those lows. You see then how oil then plummeted very quickly. Now, oil markets don't like a slowing global recession because it means less demand for oil, right? So that's why oil prices fall. So fast forward here to 2022, look, equity markets are now, this is S&P 500 in the light blue, it's now around that kind of recession zone, okay? Where you see that deep recession, when you get that 23-25% correction, normally ends in a recession. So are we now going to see a correction lower in oil? So it's just to be aware, it's nothing like official yet, and there still is a lot of supply chain issues with oil that should support it. But nevertheless, keep a careful eye on this trend line here. If this trend line breaks lower, if 108, then that does make a move back down to 96, definitely on the card. So watch out for that. Yes, Aaron, so I'm able to see your question, even though I can't access the questions properly. Aaron, so it means the recent oil downside has because of lack of demand. Yes, because the recent oil downside, it could be either profit taking on Friday ahead of the US holiday, US on holiday today, Aaron, so it could be that, or question mark, is it commodity traders starting to look and seeing, hang on, demand's going to be hit because we're about to enter a global recession. Okay, so we don't know at this stage officially what it is, but it's just like it's noteworthy. And you can see here, this is a bearish engulfing outside bar from that 115 level. So you've got bearish engulfing bar, rejecting that 115 level, and the next sort of technical move will be down to 108. So that's definitely something to be really carefully looking at. That's a big picture. Also, we'll look at gold. Now, gold, medium term, we have a long bias, but we're neutral at the moment. Now, I am long gold with my stops underneath 70.80, but this is an outlook. It's a bit speculative because what I need to see is I need to see the dollar weaken, 10-year yields fall, and that will lift gold higher. But if we see inflation rise and we can see a more aggressive Federal Reserve, we can see more dollar strength, and then we can see more 10-year yields strength, and that weakens the gold prices. You can see here, this was on Monday, the 13th of June. Gold sold off heavily because real yields were pushing high, the dollar was pushing high ahead of the Federal Reserve. We then had the Fed meet, then the dollar just pulled back, 10-year yields pull back a bit. You can see here, 10-year yields pulling back from that 3.5% region. You can see up here. See 10-year yields putting in a potential top, is it? That's what we're looking for. Now, other things to point out is the BTP bund spread. Now, let me show you what happens. You see, last week, the aggregate positioning changing is nearly 100,000 euro positions unwound their euro shorts. So there's a big unwind of euro shorts, about 100,000. Now, also, if you look here, this is the BTP bund spread. Now, this gives you an indication about fragmentation in the Eurozone. And basically, This is Italy's, Germany's Bund spread. When that rises, it means investors are fearing, particularly at the moment, a chance of Italian default on bonds. Now, that means they have to offer a higher yield to attract buyers. When bonds yields rise, it can be because interest rate hikes are coming, but it also can be a sign of distress. So when the BTP, Italian 10-year bonds rise, it's a sign of distress. They've got 150% plus GDP debt. Germany has around sort of 50–60% GDP debt. So this is seen as a risk of fragmentation. And basically what you'll see is when the euro, when the BTP bond spread rises, that tends to weaken the euro. Now that's pulled back because investors are expecting some kind of tool from the ECB to address the bond yield spread pushing higher. Now that just means there is potential for a euro-US dollar correction this week. So do watch out for that. We'll have a look at the majors and some things. Now, there's a dollar Swiss franc sell bias. I'll get to that in a minute. And there's a dollar yen. Is it a very interesting? Oh, please excuse me. I have a bit of hay fever here in the UK, and I don't like taking the tablets for the hay fever because it makes me very, very sleepy. So I just sometimes sneeze during some months during the summer. So apologies for that. Now, if you just take a look at here, the dollar yen. The dollar yen is pushing up those highs. Now, don't forget the dollar yen tracks the US 10-year yields very closely. So if 10-year yields can keep moving lower, then we'd expect dollar yen to potentially move lower as well. So watch out for that week, this week, see if there's a little bit of a top being put in there. Euro US dollar is very interesting because we've seen a little bit of a base forming there. We've got a Harari inside bar. We get a break of that 105.50 region. That does open a retest of 106 and then 106.50. Look at the dollar index, just sitting underneath 105. Now, we know because of the dollar smile theory, when the US recession or synchronized global slowdown, we see the dollar appreciate. Now, we've seen a lot of that appreciation because, you know, markets have been global surprise economic indexes have been surprised to the downside for both the world and the US, and here you can see the white the dollar gaining. But there's a lot of hawkishness priced into the dollar. So at some point we are looking for a correction. Is this it? Question mark. Obviously you don't know, but just look out for that correction. Wouldn't be surprised to see a little bit of a bounce here in the majors higher. And you can see that the big aggregate position changing, 100,000 euro shorts were unwound last week. So that would support further euro US dollar upside. Dollar Swiss franc has a clear buy, sell bias. I'll point that out to you. Now, if you just take a look at the dollar Swiss franc, last week the SMB really shocked markets with a 50 basis points rate hike. They weren't expected to hike by 50 basis points at all, and they did. Now, if you just take a look here at the dollar Swiss franc, if we get any retracements back up to that 0.9834 region, we would anticipate sellers. So if we see price move back up to that 0.9833 region, we'd expect selling from that area because the SMB hiked by 50 basis points. It was a surprise move. If we've seen peak US dollar strength, then we wouldn't be surprised to see further dollar weakness. Look at the monthly chart, and what can you see? You can see a large hammer reversal bar. So a break of the nose of that candle would open up a move back down to 0.9450, 0.9480. Okay, so a break of 0.9550, all right, yeah, 9541-ish, whatever's the break of the nose, you'd expect that to move back down to that just above 0.9450, say 0.945455, something like that. So watch out for that this week. Any retracements higher are suitable for selling. There is also a potential sell at market with stops just above that 100-200 exponential moving average, but it is higher risk. The lower risk opportunity would be a sell back up to that high with stops just above last week's previous high. So look out for that. Swiss franc, Japanese yen, there was a buy bias. SMB hiked by 50 basis points. The Bank of Japan are maintaining their very, very loose monetary policy. So any retracements down to 138 remain a buy buy on a limit. But the problem is if the Bank of Japan act or Japan's government act against yen weakness, then this could suddenly fall 300, 400 points. So you have to be aware there's a lot of risk with trading the yen at the moment, particularly with trading the yen short, because speculation is starting to build that the Bank of Japan will have to capitulate on its yield curve control, will have to capitulate on its ultra loose monetary policy. So that's the weakness. CAD Swiss franc, again, we do have a sell on rallies. Also look at Aussie CAD, we do have an upside bias on Aussie CAD, and if we can stay above that trend line, it does open up the potential for more gains in the near term. Right. I think that's sort of given us a little bit of a rundown on what's happening this week. I want to quickly go through the major events this week, and it's all about inflation. So coming up tonight, we've got our RBA minutes. The outlook for the Reserve Bank of Australia is that they are becoming more hawkish all the time. There's some good employment data out last week, and the Australian dollar has been strong today, despite some rise in COVID cases in China, and despite falling iron ore prices. So look out for the RBA meeting minutes. Any indication that the RBA will be more hawkish will lift the Aussie. Any indication they'll be less or more dovish or pausing, or not as robustly optimistic on hiking interest rates as they have been, then that would weaken the Australian dollar. Got a couple of US speeches, both from Barkin, coming up on tomorrow, so look for that in relation to what's going on with Fed interest rates. Inflation for the UK, now look, it's 9.1%. So if this comes in hot above 10%, then expect the pound to gain, as markets will start to price in 100% or more than 81% chance for 50 basis points. At the moment, investors expect the Bank of England to hike by 50 basis points, 81% chance, and they're expecting a 100% chance for 25 basis points rate hike. Now, remember the Bank of England, they've revised growth negative for 2023, and inflation is expected to go up to like 11%. So the best opportunity will come if the inflation comes in below like 8.6 or something. The inflation comes in below 8.6, and then the month on month comes in like 0.3. If the core comes in below 5.8, then expect the pound to weaken because the pressure's off the Bank of England, and then you'd expect something like significant euro pound upside, and watch out for that. If it's a very high inflation print, then expect something like more pound Swiss franc downside. Okay, that's what you want to. Yeah. Yeah, now the BOE are not only to go gradually, they're stuck with stagflationary problems, CN. So what they've got is that they've actually revised growth negative for 2023. So what investors are expecting is maybe one more hike or two more hikes, and then maybe like pausing or maybe even cutting interest rates in 2023. So the best opportunity here comes from a miss. If it's just more, there is also opportunity if it's high inflation above 10%, then the BOE would be expected to be more aggressive. Canada, now they've got inflation, and ideally we want to see a miss in inflation print. If that comes in very low, if the core comes in 5.4%, we see the headline coming in below 6.7%, and if we see the trimmed mean coming in below 5.2 or something like that, or below 5 or 5.1, the previous reading, then what you'd expect is the CAD to weaken further. So that would support something like the Aussie CAD upside or Euro CAD upside. That would make sense on that print. So that's definitely one to look at. Then got a series of Fed speakers. Thursday, got PMI data out from Australia, should remain robust. And then we've got a string of PMI prints from the Eurozone. If these disappoint to the downside, then it puts the pressure on the ECB, because then they'll be in a very similar situation to the Bank of England, where they're having to hike interest rates even as they can see growth slowing. So the verdict at the moment, I was talking about this on Friday with that Times Radio article that's on my Twitter feed. Basically, central banks have to get inflation under control, and if they don't get inflation under control, then the risk is we get a wage price spiral where inflation goes into people's wages, which then goes baked into the economy. Because once everyone's asking for more wages, then everything costs more, and once everything costs more, everyone's asking for more wages, and it becomes a spiral. Higher wages lead to higher prices, lead to even higher wages, lead to even higher prices. And once that happens, then you're looking at interest rates have to keep rising and rising and rising. And quite quickly, we're in pretty serious debt and pretty serious difficulties. So we have to be very conscious of that risk. And that's the, slowing ECB, slowing Eurozone puts the pressure on the ECB and would likely to be negative for the euro. So look out for that. If it's good data, then it gives markets confidence that the ECB can be aggressive in hiking rates. PMI data out for the UK, that is exactly the same stagflationary idea as the Eurozone. And then on Friday, to finish off, we have RBA governor speech, Bank of England speech, look at both of those, and some UK retail sales. Aside from that, pretty quiet session. Now, the most interesting print to look at is Japanese inflation print. Now, let's just see with it. Let's just see where that print comes in. Now, inflation year on year at the moment is 2.5% in Japan. Now, it's expected to fall to 2.2%. If that rate rises, and if it comes in above 2.2%, say, and particularly if it comes in about 2.6%, then investors will be afraid that inflation is starting to get out of hand in Japan. Now, I was talking about this on my interview. Yes, inflation is relatively low in Japan, but it's been building quickly, and that's the problem. So if it comes in high, above 2.5%, then you might start to see the yen gain in anticipation of some kind of action from the Bank of Japan. So in that case, watch out for something like Aussie yen shorts, dollar yen shorts, makes sense. So that's definitely something to look for. We'll get ready for that inflation data on Wednesday. And I'll just run through that again, and we'll look at some currency pairs to look at. Okay, folks, sorry I can't answer your questions very easy today. There's some problem with the software, which is pretty irritating. Just trying to think. Yeah, the only other thing to look at is China's 50. China's 50 is showing some pretty robust signs of strength. Now, this has been expected because the People's Bank of China was cutting interest rates. The Chinese economy is doing fiscal stimulus. The potential for further upside in China's 50 index is quite pronounced. Unlike the rest of the world and Western banks, see that the China 50 is actually already fallen 40+%. So it wouldn't be a massive surprise to see further gains in the 50 index over the next course of the 12-18 months. And if we manage to avoid a recession, then the China's 50 index really does look attractive for medium-term buyers. You can look. You probably don't want to try this on the futures market. You want to use something like an ETF or something you can hold for a longer term. Okay, folks. I hope that's got you ready for the week. Don't forget, on Wednesday, I will be back here for looking at the Japanese inflation print, and we'll also go through anything significant that we have, as well as those US dollar Swiss franc sell biases and the Swiss franc Japanese yen buy bias. Okay, folks, take care and have a very good rest of your week. Thank you, everyone. Goodbye.